Hi, this is Ken Boyd with the Accounting Accidentally website. This video is about dividends, stock splits, treasury stock, and warrants. Remember that you can find over 350 blog posts and links to over 400 YouTube videos on accounting at the Accounting Accidentally website. So, some very common transactions here that some people struggle with. The first is issuing common stock. So let's say, for example, that on February 1st, a company issues 10,000 shares of common stock at $10 par value. And they receive $120,000. So the first thing to note is, did anything happen to cash? Which is a good question to ask when doing any journal entry. And cash is debited for an increase of $120,000. Par is simply an accounting notation that we use to represent the number of shares of stock to post a value in the accounting records for stock. So we multiply it 10,000 shares times $10 par, and we credit to increase common stock $100,000. The amount of cash proceeds we receive above the common stock dollar amount is posted to additional paid-in capital. The next is issuing a small stock dividend. You'll see an asterisk next to March 1st where I put issue 10% stock dividend. Since the dividend is less than 20 to 25% of the shares outstanding, it is considered a small stock dividend, and this is the treatment for that dividend. Let's look at the calculation on the left. We assume 30,000 shares times 10%. That means we add 3,000 shares, 10% of the total. So for every 10 shares, you get one more share. We multiply it by the current market value of $15 to get $45,000. The journal entry is to debit to decrease retained earnings. We credit par value of the stock times the number of shares, 3,000. 10 times 3,000 gets us 30,000. And the amount above the common stock balance is posted to additional paid-in capital. That is a stock dividend, and you'll note that nothing happens with cash. Nothing happens with cash. Well, how about a stock split? On June 1st, we issue a 3-for-1 stock split, and we can also state that as 3:1 or 3-for-1. This does not require a journal entry. Instead, there's a memo entry in the stockholders' equity section that says the number of shares is now 3 times higher, 28,000 shares. In this instance, times 3 gives you 84,000 shares. And the par value is divided by 3. So we now have a par value of $3.33. So the net effect is the dollars in stockholders' equity don't change. The shares increase, the par value decreases. How about treasury stock? On May 1st, we buy 5,000 shares of treasury stock, meaning that we repurchase it and park it in an account called treasury stock. I have an asterisk that says the stock is repurchased, but may be reissued. So in other words, the stock is not retired. Outstanding, it's important to know, means held by the public. So shares in the treasury are not outstanding. They're not held by the public. Treasury stock in blue there is a contra account to stockholders' equity, meaning it's increased with a debit. So we debit treasury stock to increase at $65,000. It's a contra account. In equity, normally equity accounts are credited to increase. And we credit cash, $65,000, to pay the investors that we bought the stock from. Reissuing treasury stock. Well, what if we took 4,000 of the shares that we bought back and we reissue it at $17 a share? Again, the first question is, did anything happen to cash? If I multiply 4,000 shares times $17 a share, I get cash in the door, $68,000. We debit to increase cash. Our treasury stock cost was $13 a share, so we multiply 4,000 shares times 13. We credit to reduce treasury stock $52,000. The difference between cash and treasury stock is a credit to additional paid-in capital. Treasury stock, $16,000. You'll note that the additional paid-in capital count is different for treasury stock from normal paid-in capital that we saw in the first example. So that's the end of this discussion. If you'd like to join Conference Room, you see the web address at the top where I have chats, videos, other content, blog posts strictly on accounting where you can actually set up an account, receive a weekly notice, and be part of an accounting community. Thanks very much for watching, and we'll see you next time.